purchase and sell real estate. So I went ahead based on Carlin's, what Carlin asked me to go over. I put together a little outline. There's not a whole ton of information on this. I'm not the kind of person that does some pretty nifty PowerPoint presentations, but it'll be here on the screen so that you guys are aware of what I'm talking about. We'll talk about business structure as real estate agents for you agents. And then also I'll go over a few common deductions and some traps to avoid. Then we can move on to discussing how capital gains works for real estate and then how it applies when it's primary residence. I'll touch on 1031 exchanges and then also on deductions based on mortgage interest and property tax. Once I get through all of this, I will open up the floor for questions and answers. I think the goal is to have about a half an hour of time for questions and answers so that we make sure to get as detailed as you individually need us to in our hour here. So starting off, we have business structure. There are 4 main business structures for a real estate agent. By default, anybody who is a real estate agent is a sole proprietor. There is no filing with the state of Texas. There are no separate filings with the IRS. You simply report your income on a Schedule C. And that is the extent of what you do. If you wanted to form an LLC, which I believe you probably have all heard of LLCs and had varying levels of people advising you to start an LLC. What an LLC does is it provides a legal framework for your business as a real estate agent. Now, a quick note on that, as many of you are likely to already know, as a real estate agent, you cannot be paid in your LLC's name. You have to be paid as an individual, but you can nominee your income to the LLC and actually file your income and expenses as an LLC. Generally speaking, and I'm not an attorney, so I don't give tax advice, but generally speaking, real estate agents don't need an LLC for any sort of legal liability protections. But should you choose to have one, there's absolutely nothing wrong with that either. An LLC that is owned specifically by one person is called a single member LLC, and single member LLCs for tax purposes are reported exactly the same as sole proprietors on their federal income tax. The difference comes in that you do have a state filing that is required. There are no state taxes due until your gross income surpasses $1 million. And so that's quite a high bar to pass, but there is an annual filing you have to make. Another thing that many of you probably have heard of is S corporations. People will tell you, oh, start an LLC and be an S corporation, you pay less tax. That is a very, very delicate balance to understand, because S corporations have a requirement to pay the owner's wages. And while you can save a significant amount of money with an S corporation, I find that in practice, that doesn't apply to real estate agents very often. So my usual takeaway as a general rule is buyer beware on S corporations, but they can definitely help you if you get into detail with your particular tax accountant about how that would work. Finally, there is the idea of a C corporation. It doesn't really work for real estate agents. There's not really a way to nominee your income to a C corporation, and you probably wouldn't anyway, but I did just want to put it up here because some people have heard of C corporations. Again, doesn't really apply to real estate agents in my opinion. So some common deductions as a real estate agent that you need to keep an eye on. I put a list here and I'll touch on some of the details that we need to go over on those. Mileage is really important, and I put mileage and business use of home together because they actually play hand in hand. So at Realty One, with a lot of brokerages, there are usually two different options. Some agents will office out of their brokerage and other agents will office out of their homes. Either way, you need to understand where your business nexus is and understand what qualifies as mileage. So if you're officing out of the brokerage, the brokerage counts as a business location. and anywhere that you travel to show a home, anywhere you travel to do title, anywhere that you travel to purchase supplies for your business, all of those miles are deductible. If your business nexus is your home, then your home office counts as a business location, and the mileage from your home to the brokerage to showing homes, all of those miles are deductible. How that really comes into play is when you drive from your home to the brokerage or from your home to show a house, those miles are not deductible unless you have a home office. Okay. The best ways that I have found to do mileage is you can keep a logbook of your beginning miles, ending miles, how many miles you traveled and for what. There are people who still keep paper mileage logs. I find that the apps on our phones are usually better in that they are taking all of your trips and you just have to classify them. And in the event that there is an audit of your mileage, you're able to pull that report and the IRS will accept it as a contemporaneous mileage log. So something like Mile IQ will get you, I think it's about $60 a year, will get you everything that you need to know how much mileage to deduct. Quick note on Sabre, that's here in San Antonio, so this is my San Antonio one, but I'm sure you have an equivalent in Austin of the Board of Realtors and fees. The one thing to keep an eye on when you're claiming some of the fees that you pay is when you look at the realtor, I forget what it's called, there's a paper that says how much you owe. Some of it will say how much of that is going towards lobbying activities. And you do need to take note that when you pay into a trade organization, the amount of your payment that goes towards lobbying activities is not actually deductible. I have people who will always claim all of their fees, and I have other ones who will never claim any of them based on that information, but you actually need to just kind of find that middle ground if you can. A little bit more in depth, I will go on meals. There is no longer an entertainment deduction. You may have heard it called meals and entertainment. There's no longer an entertainment deduction. So the way that really works out, and what you'll see is, I like to look at it in terms of Topgolf, because I have a lot of clients that do things at Topgolf. If you go to Topgolf and you pay for golf and you pay for food and you pay for alcohol and it's all on one receipt, the IRS is going to tell you that's not deductible at all because it's entertainment. If you pay for golf on this receipt and then on this receipt you pay for food and this receipt you pay for alcohol, the IRS is going to tell you that only the food is deductible because the alcohol and the golf are entertainment. To really throw a wrench in it, if your food and your alcohol are on the same receipt, it's all considered meals and it is fully deductible. So in any case you can where you're going and covering meals for a client, for another realtor, for a photographer, or a title company, or however you're doing your advertising, whoever you take to meals, make sure that your meals and your alcohol are on one receipt, and any entertainment you do is on a separate receipt because that entertainment's not deductible. Finally, a big one is gifts, because I know as real estate agents, you give a lot of gifts, closing gifts and things of that nature. In the event that the IRS is taking a look at your expenses, you are limited to $25 per person for a gift. So if you have a couple purchase a house and you provide them a gift, technically you can only deduct up to $50 of that gift as a business expense. There are some tips and tricks around it. If you were my client, I would show you how I would personally claim the entire amount of the gift, but that's not something that I can advise you kind of on as a general rule. So it is something to keep an eye on. Make sure that you're not over claiming on your gifts. Now, moving on to capital gains when people sell houses. I have information up here. This is one of those things that can get really complicated really quickly. So I'm going to kind of do my best to summarize to a point where it gives you the information you need and not necessarily anything you don't. But the important things to understand in capital gains is your purchase price and your sales price. So when you sell a home, the sales price is what you claim as sales price. And then every cost of selling that home is considered basis. And your basis price is your purchase price. It's the cost of any improvements made to the property. Real quick, the difference between improvements and repairs is if I walk into a house and I paint a bathroom, that's not an improvement. If I walk into a house and I paint the entire house, that's an improvement. If there's a busted pipe in the bathroom and I repair it, it's a repair. If I then just pull out all the plumbing, redo the plumbing, add a new bathtub, that becomes an improvement. So it's kind of hard sometimes to find where the line is, but the cost of the actual improvements to a property will be calculated as part of your basis. And then really commonly, you won't hear people talk about this, but actually the cost of acquisition and sale goes into the basis as well. So as real estate agents, you're familiar with commissions. The total commissions when you purchase it, so usually around 3%, and the total commissions when you sell it, also usually around 3%. Whatever portion of those that the seller paid when they purchased it or that the seller paid when they sell it, that goes towards basis as well. I have an example on the next page that kind of shows how that comes into play. But the other thing, and then with capital gains at that point, you're going to pay capital gains taxes on the difference between the sales price and the basis. So sell a house for $300,000. You have a basis of $250 by adding these things together. They're going to pay $50,000 in capital gains taxes. We will talk about primary residence later, so just don't stop and think what. So 50,000. The other thing is, a lot of times when talking about real estate, if we're talking about investment properties, non-primary residences, when you have a rental property, you take depreciation every year, which is basically 3.63% of the price of the home, of the basis in the home you take as depreciation. When you sell that house for a gain, you actually do have to essentially claim that depreciation back as income. And I'll show you an example on the next page. The difficult thing about that is that that's not subject to capital gains tax rates, which are generally favorable. It's subject to regular income tax rates. So as an example, if you have a home that you purchased for $275,000 and you rent it out, over 5 years, you're going to take $50,000 in depreciation. That's $50,000 in expenses off of your income over the course of 5 years. And then you turn around 5 years later, you sell it for $350,000. There's going to be a capital gain of $125,000 because you take the depreciation away from your basis. So $225,000 out of the $350,000 sales price, you're going to pay capital gains taxes on this much, but in recapturing the depreciation, you're going to pay $50,000 in regular tax on that sale. So it's a lot, and it's a complicated thing. But just to the point that I try to make is that there are really major tax implications for the sale of real estate. My head just exploded. Yeah, it really can, Gabe. It does sometimes when I'm looking at it too still. Just so you know the capital gains tax rates, just for fun, I put the numbers on here, but the basic idea is that you'll actually pay 0% capital gains on income. And this income number that I put here, 41,000, this is for a single person, 83,000 is for married filing jointly. And this is total income for the year. So if somebody has $50,000 in wages and then they have a $20,000 gain on the sale of property, their total, at 50,000 as a married couple, their total income would be 70,000 and they'd be in the 0% rate. So they will actually pay 0% in taxes on that income. The most common one that you see is going to be the 15%, because that applies to all income up to this threshold, essentially $450,000, $500,000 in income. So and that's 15% on whatever the gain is, and then pay your regular tax rate on the rest of it. If somebody is a high income earner and they're over these numbers, their capital gain rate is going to be 20%. Now, just to give you some context on that, ordinary tax rates hit 20% at like $50,000 or something like that. So capital gains rates are way favorable to ordinary income tax rates. Like I said about the depreciation recapture, just so you know, I don't know why I left the sections in there, but essentially if it's real estate property, the depreciation recapture is based on your ordinary tax rate, but it's capped at 25%. So the highest bracket's 37, you're not going to pay 37% capital gains on the sale of a property on that depreciation recapture. So that gets into the primary residence exclusion. Now, capital gains rates, whether it's your primary, capital gains are calculated the same way, whether it's your primary residence or a rental property. The capital gains calculation is exactly the same. Okay, whatever number, like let's go back to our example here. This $125,000 in capital gain, let's assume that there's no depreciation taken because it's a primary residence. So the capital gain is going to be $125,000 on this property. Okay, when you have a primary residence exclusion, when it is a primary residence, if you're single, you get to exclude up to $250,000. If you're married, you get to exclude up to $500,000 in capital gains. So that $125,000 in capital gains is wiped out because you don't have any tax due on that. If as a single person, that calculation actually ended up at $300,000, you would be paying on $50,000 in capital gains. The two most important things to remember are, in order for it to be a primary residence, considered a quote unquote primary residence, you have to live in it for 2 out of every 5 years, so, over the last 5 years. So if you sell it on, today's February 17th, 2022, you must have lived in it for 2 years when you start with February 18th, 2017. So if you lived in it for 2 years, and doesn't matter what you did with it the other 3, it counts as a primary residence. What you really need to keep an eye on, especially, like I said, I'm down here in San Antonio, Military City, you have a lot of people moving in and out. If you come here on an assignment, if you're stationed here and you buy a house in 18 months, let's say you're stationed here and then you rent for a little bit and you buy a house, and 18 months later you sell your house, you've only lived here 18 years. So whatever gain you have, you do not get this exclusion because you did not live here for 2 years. The other thing to remember is that this exclusion is per a 5-year period. So you can have 2 primary residences in a 5-year span, but this is still the most you can exclude. So if you do it once and you have a $200,000 gain as a single person, you're not going to pay capital gains. But if you do it a second time and you have a $200,000 gain, then you are going to end up paying on $150,000 because you are capped at this amount in a 5-year period. So those are the 2 things to really watch out for to make sure people do get that exclusion.
Edward, can we have a question? Yeah, since we're on that slide real quick.
Yeah. Hold on. Let me go back.
Okay. Does the 2 years have to be consecutive, or can there be a break?
No, there can be a break. So there are instances where I will have people who have a home and they let their sister live in it or something for a few years and ended up being 4 years. They'll move back into it for a year just to get the 2 years, just to hit the 2 years to sell it.
Awesome. And on that too, we know the 250 and 500 as the sales price, but let's say we sell it for 650, we still get to do that basis calculation, right? Okay.
That's correct. So if you sell it for 650, whatever the purchase price, the improvements, the cost of the purchase and sale, that all comes off first before you do the exclusion. Yep. And then John asked, what about depreciation recapture? If you use let's say you live in it for 2 years and then you rent it out for 3 years, you're still going to be subject to, you're still going to have the capital gains exclusion, but you are still going to have to pay on the depreciation recapture. So, and let's say you rented it out for 10 years and then you used it as your primary residence, you still have to recapture the depreciation over those 10 years, even if you lived in it, even if that depreciation isn't in this 5-year window that we're talking about.
While we're on this too, do you want to talk real quick about if you've been writing off the business use of your home and you go to sell, how that applies on this as well?
Yeah, so business use of home, when you actually, that's something I probably should have covered when I was talking about common deductions. Just FYI, as realtors, there is a consideration to make in your business use of home. There is a standard business use of home based on the square footage of your office. And then there is the actual expense method. Generally speaking, if you are renting, I love the actual expense method because it's always way better than the standard. But if you are owning the home, you are taking depreciation on the home that you, if you're taking actual expenses, you do need to take depreciation. And in that sense, when you go to sell the house, you do have to recapture that depreciation. So business use of home can include, you are writing that off of your business income, but you will have to claim it again as income down the line. From a tax planning perspective, I will mention that taking the deduction saves you on self-employment taxes, and then recapturing it later, you don't have to pay those self-employment taxes. So I do still generally recommend people go ahead and take the depreciation, but just know that when you go to sell the house, you are going to have to pay income taxes on that depreciation. Does that answer your question, Carla? Makes sense? A little bit?
Yeah, exactly. Yep. Thank you.
Okay. Yeah. Okay. 1031 exchanges. I will be completely honest when it comes to 1031 exchanges. I do not do these very often because, especially, when I first started out, there were, but with the super low capital gains tax rates, you really have to make a calculation, because what a 1031 exchange does is it defers your capital gains taxes. So instead of taking capital gains and instead of doing that capital gain calculation, okay, let's do that one, $125,000 in capital gain. Okay, instead of paying capital gains taxes on it right now, what you do is you make that your basis in a new property. Okay? And so you don't have to pay the taxes now, but down the line, you are going to have to pay the taxes. Right now, capital gains rates are pretty much their lowest that they've been, and anybody who pays the slightest amount of attention to politics can tell that capital gains are kind of on the chopping block, at least with the Democratic Party. So if it gets to a point where they can do something about capital gains rates, the only direction they're going to go is up. So from a planning perspective, you do have to understand that maybe deferring your gains now, but that tax may actually be higher. That being said, a 1031 exchange does not apply to primary residences, but it does apply to any other real estate for business use. So it can be an investment property, it can be a rental, commercial, residential, it can be land, but it has to be real estate, and it can't be a primary residence. And what you do, like I said, is you sell a home, and there's a window of time, and usually you go through a 1031 exchange company, but there's a window of time where you sell a property and you use the proceeds to purchase another property. And in so doing, you're able to essentially, it's a hard calculation, but essentially you just defer that gain. So if you have $250,000 in gain and you're purchasing a new property for $750,000, then essentially your basis in that new property is $500,000. The thing that a lot of people don't talk about when they talk about 1031 exchanges is you still have to, you still have to recapture depreciation. So it's not a completely non-taxable event when you do a 1031 exchange, because a lot of times you're taking depreciation on an actual structure, and you do have to recapture that and pay taxes on it as part of that exchange. I would highly recommend that anybody who's considering a 1031 exchange consult somebody who specializes in them. There are people who are non-tax accountants who specialize. There are tax accountants who specialize in them. And then there are companies that are actually facilitating the actual 1031 deals that I always recommend people go through, because the number of times that I've seen somebody go, oh, well, I did this 1031 exchange, and best case scenario, they didn't understand how much tax they were going to pay and didn't set it aside. Worst case scenario, it doesn't actually qualify as a 1031. So you really, really, really need to seek professional help on those. Okay, and then the last one before I get to Q&A, I have gone a little bit over the half hour, but excuse me. So a lot of people know that your mortgage interest and property taxes can be deducted on your personal tax return. These are called itemized deductions. And down at the bottom of my slide, I show the standard deduction as part of the Tax Cuts and Jobs Act in 2017. The standard deduction went from a few $1,000s. They actually wrapped in what's called the exemption credits in there. So the standard deduction is actually now $25,900 for a married couple. It's half that for single, and 75% of that for head of household. Because of that, and because of one other factor, a lot of people are no longer itemizing. So just to give you an idea of what common itemized deductions are, is medical expenses over 7.5% of your income. So if your taxable income is $100,000, you can claim medical expenses over $7,500. So a lot of people, because of health insurance, don't generally cross that threshold unless they have some major medical issues or are uninsured. Then there's charitable contributions, which, a lot of times when I see charitable contributions, there are the people who don't contribute anything. There are people who contribute, $500,000 a year. And then there are the people who pay tithes and they're paying 10% or, somewhere in that range. A lot of times people who are actually itemizing are the people who are paying a lot in charitable contributions, a lot in medical expenses, and have mortgage interest and property taxes. The other one is state taxes, and this doesn't apply in Texas as much as out of state, but in states that have income taxes, your income taxes and your property taxes, your deductions capped at $10,000. So the reason I'm kind of going over all that in terms of it is you will have a lot of first-time home buyers that will come in and they'll say, oh, I'm buying a house, I can claim the mortgage interest and the property tax on my tax, as a deduction on my taxes. Technically, yeah, as an itemized deduction. But honestly, especially with first-time home buyers, 99% of the time they're taking the standard deduction. So it's not going to make a difference on their return. Okay, that being said, I've probably done enough talking. Hopefully there aren't too many glazed over eyes, but I would love to open it up for questions and answers. Carlin, you let me know the best way to do that.
Yeah, why don't we have you guys throw them in chat if you can. That way we can kind of go in an order and we're not talking over one another. I'll start with some other deductions for agents. Sometimes they'll be advertising. So one way, I won't say you can get around the gift issue. And keep in mind the IRS write-off for a gift versus Trex rule on gifts is two different things. So we have a Trex rule on gift that limits it to $50. But $50 to $50. But advertising, the minute you put your brand on it, your logo, your name, phone number, those sort of things, then that may be able to be considered an advertising expense. Is that right, Edward?
You said it, not me. But yes, in terms of in terms that I'm not giving accounting advice, you are absolutely correct.
Okay, all right. He's not giving advice.
I cannot give general advice, but yes, that is one definite way. And you didn't hear me say this, but that's my favorite way around it.
The mug is. Yeah. All right. Let's see.
Put a
Jenny's got
business
a
card.
question. Yeah, right.
Okay, let me get my glasses back on so I can read it.
Here, yeah.
When a couple divorces and one pays the other for their half of the house in the settlement, does this affect their exemption amount? Great, Jenny, that is a great question. Thank you so much. So it depends. So if you have a couple that divorces and sells the house, you're going to have a capital gain calculation, and generally speaking, whether they file, I've had couples who have sold a house and still filed joint for that one last year. And I have couples who sell it and then they file single for that year. But in both cases, if they're joint, they're going to claim the whole sales price and they're going to claim their $500,000 exclusion. And if they're single, they're going to split the sales price, and each one of them is going to claim their 250. So in both cases, whether filing joint or filing single, and the house has been sold, they get their full exemption. Now, where it gets crazy is one, yeah, what if it's not sold till years later? Yeah, so that's the other case, right? So when you have spouse A and spouse B, and they buy a house for, let's say, $200,000, then at the time of a divorce, one of the two has to buy the other out at value. Technically, the owner of the home. See, I'm trying to figure out the best way to explain it. Because Texas is community property state, you only own half of it. So you're actually selling your half for a gain. So there is a gain calculation involved. So when you sell your half of the house to another person, you take your half of the basis and you've sold it, and you have to claim that gain. When you claim that gain, you still have your $250,000 exclusion. But where, so that's usually pretty cut and dry to the person who's selling. To the person who's buying it, their basis in that property has now changed. So if they purchased it for $200,000, their personal basis is $100,000. And if they bought the other half for, say, $250,000 because the house price has exploded, well, now their whole basis for the property is $350,000. And I hope that answers your question. I'll give you a second.
Yeah, you definitely refer.
Okay.
And then John's got a question.
Is that John on the property taxes? Okay.
Yep.
If you pay property tax for 2021 on the 1st of January of 2022, then pay property tax for 2022 on December of 2022, is that deduction all for 2022 taxes, or does it go on the year the taxes are due and not paid? So again, great question, John. The year that the taxes are paid are the year that you deduct them, whether it's a rental property or personal property. So another instance where I have seen some itemized, somebody who doesn't usually itemize, actually itemize, is when they haven't paid property tax in like 3 years and they end up paying all of it in 1 year. That may or may not apply to my personal tax situation this year. And then, they pay all of them in that 1 year and they get to deduct it all in the year that it's paid. So yeah, and that actually applies to a number of deductions as well. And the one where you see it the most commonly is actually student loans, because student loan interest, you get a deduction for paying it, and student loans the interest just sits on that loan until you actually pay it. So people who may, take that last amount and just throw it, pay off their student loans in 1 year, they're going to get, to claim all of that interest in that 1 year.
Awesome. What other questions do you guys have? While anyone's writing or thinking of a question, I'm going to throw out that one piece of advice I have for agents in tracking your expenses is to either open up a checking account and use that debit card to pay all real estate related expenses. So it's all in one account and easy to see every month, or use one credit card just for real estate expenses. So that way you're not trying to, at the end of the year, go through your checking account where there's 50 transactions and figure out the 2 out of every month that were real estate related or that sort of thing. It makes it so much easier to keep it on a separate system. And Edward mentioned apps. My husband uses TaxBot, which is a great app, not only for tracking mileage, but every time you are at a meal, you immediately snap a picture of the receipt and file it in the app. And so that's another great tool. I think it's about $99 a year.
Yeah.
Marlon, what do you
TaxBot
use?
is really good.
Carlin uses Edward. All of my stuff is run through businesses, just depending on what business is paying the expense. And so I use QuickBooks to track everything. I have, 4 different
So
QuickBooks.
you snap a picture of your receipt and send that to Edward? I'm kidding.
No,
I'm kidding. I'm kidding.
no, I collect them all and then eventually ask somebody to photocopy them and file them away for me.
Yeah. So on that note,
Yeah.
TaxBot, QuickBooks Self-Employed are both really good. There are a number of like receipt capture apps that will help you do that as well. When you start having a lot of volume, I highly recommend something like QuickBooks Online, where you do actually have the ability to upload receipts into your books as well. But definitely the other consideration to take, and just because it's something I should preface by saying that the likelihood of getting audited, you hear people talk about getting audited all the time. The likelihood of getting audited is really low. And I preface by saying that because I think a lot of people worry about it a lot more than they need to. But in the event that you are audited, one really nice thing about having a separate bank account specifically, whether you're an LLC or an individual, if all of your business income and expenses are captured in one bank account, when you get audited, if you get audited, the IRS will look at those bank statements and they will not be looking in your personal accounts. Whereas if you are doing it all in your personal account, the IRS, when going to have you prove those, will be looking through all of your personal bank statements. So if you do have an LLC, absolutely have a separate bank account because that's what LLCs are for. But also as a sole proprietor, have a separate bank account and make sure it all flows through there so that if the IRS comes knocking and says, prove all of these income and expenses, you can be like, okay, here are my bank statements. And then they're like, okay, well, it's all here, so we don't have to look at anything else. Gabe, did you have a follow-up on that?
Yeah, I had a question to elaborate on that. Thank you for doing this, by the way. It's been very helpful. So if I have a separate bank account and basically my gross pay like matches, it shows that it's all in there. And you said that they're not going to look through all your deductions. Did I hear you correctly? Or you said you're not going to look through all your personal? If you could explain that part again.
Yeah, sure. So when the IRS, I'll expand a little bit too. When the IRS does an audit of a business, even if it's a Schedule C business, like if you're just a sole proprietor, they're looking for you to show your income and your expenses. And if you have all of your income and expenses in one bank account, where like you're taking your checks from Realty One, you're taking your checks and you're depositing them there, and then you're paying for your client gifts, you're paying for your advertising, you're paying for your Saver fees, you're paying your MLS fees, you're paying all these out of this bank account. When that's reflected on your tax return and on your bank statements, and they're comparing the two, they have no reason to look at anything else except for those particular expenses, so except at those particular bank statements. And when I say that, it's because when you give them your personal bank statements, you're opening yourself up for a whole lot more scrutiny than just your business. Does that answer that for you, Gabe?
Yes. So I made the right move by opening that separate bank account earlier.
Always a right move. Now, really quickly, let's see. Jenny, if you sell part or a piece of undeveloped land you own, is the basis and sale difference based on the per acre price at the buy and sell times. If you sell a piece of undeveloped land, okay, so when you purchase land, yes, it's based on acreage. If you have like a site survey and evaluation that shows that a particular piece of your land is worth more, you would use that in terms of your basis as a percentage. But generally speaking, yes, you would cut it up on a per acre price. So if you have 100 acres and you sell 20, if you have 100 acres and you bought it for 100,000 and you sell 20 of them, your basis is going to be 20,000. That really out in rural Texas, that's going to apply like 100% of the time. Where you have to be careful is if you own like a piece of land, say just outside the city limits, and some of it happens to be like, on top of a major road or something like that, that road front property is going to be worth more. And I would highly encourage you to get a valuation in order to determine your basis. And then Carrie, if I have a DBA with a tax ID, does that come into use as my sole proprietor, or is that kept separate? It was originally created for a buy-sell business. I mean, service business, then our business. Does that come into use? You can use your DBA with a tax ID as a sole proprietor for sure. It just matters as to how you choose to claim your income. So like I mentioned earlier, all of your real estate commissions are going to come in your personal name, but where you deposit them, the bank account that you deposit them is where you can claim them as income. So I hope that answers it. And then
You just
Jenny,
may want to, like you mentioned with me before, if all of a sudden that number is now claiming income under a different type of business, then it may need a different, I guess if it's still a sole proprietor, then it won't matter.
Oh yeah, so you can, and actually Jenny's next question touches on that too. So let me read that real quick. Can your LLC for your realtor work encompass any kind of real estate activity, such as development, buy, sell, commissions? So, okay, LLCs, sole proprietorships, basically any business that you operate regardless of the structure needs to be for a specific business use. So whatever you determine that specific business use to be is valid. So if you want your LLC to be all of your real estate activity, such as development, buy, sell, commissions, and all that, that's fine. You can claim it that way. If you want your LLC 1 year to be for real estate commissions, and then you just, completely give up real estate and, become an artist, then you can use that same LLC for that purpose. Generally speaking, though, I find it better to start a separate entity. And also just for cleanliness purposes, and you can stop using an EIN at any time. If you're not making money on it, you can just go and get a new one under a new name, under a new DBA or LLC. Then also to that point that Jenny made here, can your LLC include that work? One thing you have to take into account is that LLCs are created for protection, for liability protection. And so as a real estate agent, your liability, and again, this is kind of touching on the legal side without me giving legal advice, the liability of being a real estate agent is actually really low. If any of you have sought insurance, you're going to know that your rates are actually really low for what you do, because you're not doing anything that's going to cause somebody to be able to sue you for a significant amount of money. Let's say that you were a real estate agent and you were doing real estate inspections. Your liability much higher as an inspector, because if something happens that you should have known that you didn't tell them about, you're now liable, right? So when you use your LLC for your real estate commissions and for property inspections, if somebody sues you because of something that happened as an inspector, they can come after your commissions as well, right?
Let me jump in there real quick while we're talking all
Go
this,
for it.
because it's making me as your broker nervous. Keep in mind, guys, keep in mind, Trex says if you have an LLC out there, I can't pay it. I'm paying you, and then you're paying the LLC. But Trex suggests that you have E&O insurance for that LLC, even though you're protected under my E&O under the brokerage, because if somebody does decide to sue everybody and they see you as agent have an LLC, they can sue the LLC too. And so it can bankrupt your LLC if you don't have E&O protection. So that's something to consider. And then I just want to really clarify and make sure you guys understand that I, as your broker, I can only pay licensed entities or licensed individuals. And so that's why I can't just go pay these LLCs, because unless there's a broker of record for that LLC, then it's not licensed, therefore I can't pay it. So just want to make sure everybody understands that. I don't want everyone running out, getting at LLCs and then they think I'm cutting commission next to them.
Are the majority of your agents just SPs or DBAs? Like, is that?
Yeah, most of them are SPs. A lot of, you'll see a lot of DBAs for like team names, that kind of thing. If you do decide to operate under a team name or some kind of name in advertising, then I have to file that DBA with Trex. So keep that in mind as well. Like if you're just paying your LLC for tax reasons, then Trex doesn't care. But if you're going to advertise that, it needs to end in the word group or team. It cannot appear as a brokerage. And I have to file that with Trex. So you'll need to get me paperwork on it.
So Edward, you were saying that
and on that,
basically for most people, because of how the deductions changed, like you don't necessarily need an LLC unless you make above a certain amount of money a year, and then maybe it's beneficial because of the deductions. So I guess it's changed since I started doing it.
Yeah, generally speaking, for my real estate agents, I don't generally recommend that they get an LLC, really at any point. It's when I have realtors who decide to go into the real estate space as a buyer, whether that's land and new home building or development, or buy sell or flipping, or however you want to refer to it. Once they start going into that sphere, then I recommend that they get an LLC, and I recommend that they keep it wholly and completely separate from their work as a real estate agent. So as a real estate agent, just to be clear, I don't recommend LLC. It just adds expense.
What about SCorp?
What about, at what point would you recommend an SCorp?
I would never, at this point, I've never recommended to a real estate agent to become an S corporation. The only times that I recommend S corporations are when you have a business where you are actively involved to a point where you should be getting paid, but you also have other people who are generating income for your business.
So like our teams.
Yeah, so like if you wanted to have an S corporation, because what an S corporation does is it prevents you from paying a 15%. Oh, that was something I meant to add in here. And then we're going to jump to Carmen and John's next questions. But the big thing to remember is that as a real estate agent, you're generating self-employment income. And if you've never generated self-employment income, you need to understand that you are going to be paying a much higher amount in taxes than you would have when you were a waged employee. Because the big difference is that as a waged employee, you are paying into your own Social Security and Medicare at 7.65% of your income, and you're having your income taxes withheld by your employer. So when you work a work week, let's say 40 hours at $15 an hour, okay, that's a $600 paycheck, but you never get $600 on that paycheck, right? You get that amount that's, sometimes significantly less because those taxes are being paid. When you are self-employed, nobody's doing that for you. You get your $600 and you still owe all those taxes, and you're going to owe another 7.65% on top of that $600 because that's the employer portion. So when somebody pays you a wage of $600, they're paying you that $600 and they're paying your taxes on your behalf, but then they're also paying an additional 7.65% for their portion. when you are self-employed, you are that person. So generally speaking, if I'm giving general advice, I encourage real estate agents to withhold something between 35 and 40% of their commissions to cover their taxes at the end of the year. You are keeping back too much, and you will have leftovers after you pay your taxes. But when I'm giving general advice, I encourage people to do that, because I hate when people go, oh no, here I am at the end of the year, here's this $15,000 tax bill and I don't have this money anymore. So let's see. So I want to hit, because we're running low on time, Carmen's question. If somebody sells their own home and in order to sell it has to spend a good amount of money in repairs, how are the expenses treated after the sale? If it's a personal residence, Carmen, if it's a personal residence, you don't get to claim expenses. But to the extent that any of them are improvements, like this bathroom is in such terrible disrepair that I have to remodel it and it's going to cost me $8,000, and I won't be able to sell this for anywhere near what I need, well, then it's a capital improvement and you can claim it as part of your basis. But slapping a coat of paint on a couple rooms, or fixing the holes in a couple walls, or replacing a few floor tiles, things like that, you don't get to claim an expense. If it's a rental property, then it falls under repairs and you can claim it on your rental property. Then John asks, so if you're an investor and have an LLC, that account should be separate from your realtor account. Yes, John, yes, I highly recommend that you keep your realtor activities separate from any other real estate activities, if only because, for a number of reasons, it makes for cleaner reporting, and there are liability issues involved there to take into account. So I do recommend that you keep those separate. And then Carrie, again, if I remodel my condo in a given year and don't sell it the same year, can I claim those remodel expenses? Yes, if they're improvements, it doesn't matter if that improvement was last year or 20 years ago, you can claim the cost of the improvement as part of your basis. So 21,000. Oh yeah. If you're remodeling,
but he's talking about basis for avoiding on sale, not on your taxes for the year you did the remodel. It's very different. I think she's thinking maybe a little differently.
Oh, okay.
Before everyone goes, I want to give a piece of advice that I was told early on in my career, and it really helps. So if you take all of your checks and deposit them into your business account that you create, then have a savings account where automatically that 35 or 40% goes into savings and you never touch it, right, till the end of the year for taxes. Then have another account for maybe future business. So like, let's say you decide you're going to dedicate 10% of all your income for advertising and future marketing and client appreciation events, whatever. So have another account for that kind of stuff. And then the rest can go into your personal account where then you pay your personal. So it's kind of like forcing a savings system, and doing it with separate accounts really helps make it clean. And I tell you, ask any of my agents who have been doing this 5, 10, 15 years about how much they wish they became automatic savers for the IRS, because agents love to say, oh, I'll just have a sale in April and then I'll pay my taxes off with that commission. And it never happens and never works out that way. I have an agent who will stay nameless. I will not give out her name, but one of her first years with me, I made her set up the savings. She was savings for her taxes every year. And she had so much at the end of the year, she bought herself a gift. She was able to pay the IRS taxes, and then she bought herself a personal gift, and it was a little uplift, and that's all I'll say to it. But it's nice to have that cushion at the end of the year that you don't necessarily need. So I highly recommend doing that. Thank you so much, Edward, for all of this. We really appreciate it. It's been very helpful.
It's my pleasure. And, obviously Carlin has all my contact information. If anybody has questions, I'm happy to help. So.
Awesome. All right. Well, we will let you get back to your day, and you guys all have a great day. And if you are new agents wanting to join me, I'll be jumping on the other Zoom in 2 seconds. All right, guys. We'll see you later.
Thank you.
Thank you, Edward.